In the previous video, we discussed in detail how retail traders get trapped by inducement candles in the market. In today's video, we'll cover how you can safeguard yourself against this inducement trap. If you want to steer clear of inducement traps or false breakouts, you'll need to identify the liquidity of retail traders in the market. Let's now examine some techniques for spotting retail trader liquidity by analyzing a chart. Let's dive in, but before we continue, if you find this content valuable, hit that like button, and if you're new to the channel, make sure to subscribe and enable notifications so you won't miss any of our upcoming uploads. I'll see you right after the intro and disclaimer. Number 1. Slow and steady directional moves. If the price on the market chart is gradually moving upward, forming higher highs and higher lows, then your risk of getting trapped increases. Observing this, many retail traders enter long trades at lower levels after each price retracement, placing stop losses below. This results in a significant number of stop losses being set below the level, creating substantial liquidity. Consequently, the price reverses and moves downward, capturing this liquidity. There is a higher probability of these small corrective moves occurring at these points. Operators place minor selling orders, causing the price to decline gradually. Often, in such scenarios, after a small breakout in the direction of retail traders' entries. As soon as the option premium spikes, the price drops sharply due to large selling orders executed by operators at higher levels. Therefore, breakouts do not truly occur in the market. They are orchestrated by operators to trap as many retail traders as possible. Let's now analyze this on the chart. This is a 5-minute time frame chart of Nifty 50. Here, as soon as the market opens, the price slowly moves upward, forming a sequence of higher highs and higher lows. Observing this chart, the first thought that comes to a retail trader's mind is that the market is continuously rising, breaking previous highs, and the price has never fallen below its previous low. This indicates, based on price action, a bullish market structure. Such assumptions naturally arise. Now, this is a retail market. A trader's view of this chart differs from that of large institutional traders, whom we call operators. They do not analyze price action like retail traders. They enter trades purely based on their profit and loss. In the stock market, when one person gains, another loses. Hence, when a retail trader loses, a large institutional trader profits. This is the principle on which the market functions, and it must be understood. Looking at this chart, a retail trader with a bullish perspective enters a long trade whenever the price retraces and touches the trend line. This implies that if the market rises above this point, the retail trader profits, and if it falls below, they incur a loss. On this chart, retail traders' stop losses are positioned in the lower areas. Therefore, when the price breaks out of the small resistance zone forming above, it attracts more fresh retail traders, placing additional stop losses in this zone. With operators acquiring the liquidity they need to execute their orders, the price suddenly drops sharply without a pullback, causing losses for retail traders as their stop losses are triggered. Losses are incurred, and profits are realized by operators. This cycle repeats daily across all time frames. Therefore, you must enter trades in the direction of large institutions. To do this, you need to observe both the price action on the chart and the liquidity created by retail traders' stop losses. Let's move on to the next technique. Number 2. Strong momentum candle breakouts. Whenever the market trades within a range, it repeatedly tests one side of the range and attempts to break it, only to return to the same zone. Many retail traders plan to enter trades on the breakout of this range. This level becomes psychologically important to them, and they become eager to act on the breakout. By placing their stop losses in the breakout direction, liquidity is created. As soon as the market breaks below this level with a strong momentum candle, the remaining traders get excited and enter short positions here. Once they enter, the price dips slightly, triggering buyers' stop losses and sweeping the liquidity in this area. Then, it reverses and pushes upward. Let's understand this more clearly on the chart. Here's a 5-minute time frame chart of Nifty 50. As soon as the market opened, the price gradually moved down, repeatedly testing the psychological level of 25,000 but failing and returning to the same range. Observing this, many retail traders had already planned short trades here. Some had already entered shorts, with their stop losses positioned above this level. Shortly after, at 11:02, a strong bearish momentum candle broke through this level. If you compare this breakout candle, it is far larger than any prior candle. Believing the market would definitely fall further, retail traders entered short positions here. Immediately after, the price reversed, returned to the zone, and continued trading near this crucial level. Retail traders who missed the breakout then placed fresh entries here, which added even more stop losses in this area. Now, the stop losses of earlier buyers had already been cleared by the momentum candle, but several new stop losses still remained above. This created the highest liquidity concentration. As interest in short selling weakened, the price climbed higher, forming large bullish momentum candles, hitting stop losses and causing losses for retail traders. Another example is this 5-minute time frame chart of the mid-cap Nifty. In this uptrend, the price moved upward, forming higher highs inside a range. Many retail traders entered long positions as soon as a strong momentum candle broke out of this range. However, shortly afterward, the price reversed, triggering their stop losses and resulting in losses. Therefore, whenever you see a chart and assume the market will move higher or lower, and a strong momentum candle forms in that same direction, most of the time such breakouts are traps set for retail traders. If a level is broken by a large candle, you should avoid entering in the same direction of that breakout. Out of 10 cases, such a breakout might succeed twice and give profits. But in the remaining 8, it will trap you, wiping out gains and causing heavier losses than previous profits. Hence, you should avoid entering trades immediately after a momentum candle. Number 3. The importance of candle closing. Often, the price approaches a key psychological level on the chart and breaks it with a candle, but the candle fails to close above that level, causing the price to reverse. The main reason for this behavior is the liquidity of retail traders clustered around that zone. Some retail traders in the market sell options in a non-directional manner. This means they mark a level above and a level below on the chart and sell options at those levels, assuming the market will trade only within that range. Since they are not concerned with market direction, this practice is called non-directional selling. Now, because the stop losses of these retail sellers are positioned around those areas, the market frequently reverses near such important levels, sweeping away the liquidity present there. Let's clarify this with an example. This is a 5-minute time frame chart of Bank Nifty. After opening with a gap up, the market immediately moved downward, and as it approached the crucial psychological level of 51,000, a strong bearish red candle broke this level. However, the candle formed a long lower wick and closed near the same level. The next candle also opened below but closed above this area once again, trapping retail traders who had entered short trades after the breakout candle. Traders who had shorted at higher levels profited as the price fell, with some booking gains at this zone. At the same time, as the price approached this level, certain traders viewed it as support and entered long positions. Meanwhile, those engaged in non-directional selling, with stop losses placed near this point, were taken out as their liquidity was absorbed. This buying pressure caused the price to reverse and climb quickly, trapping retail traders. Whenever the market makes a sharp move and breaks a key level without hesitation, you should avoid entering on such breakouts, as the probability of a reversal is high. However, if the market approaches the level, consolidates, trades around it for a while, allowing new participants to enter, and then breaks the level, you can enter in the breakout's direction. Since your stop loss in this scenario is tighter, your risk remains lower, making your trade entry consistent with proper risk management. Number 4. Always mark important areas on a larger time frame. This is the 5-minute time frame chart of Bank Nifty. Here, the price takes support near the key psychological level of 51,000 at the lower range, then moves up rapidly, breaking the previous day's high and moving above it. Since the market broke the previous day's resistance level, many traders entered long positions here, but immediately after their entry, the price touched 51,400, then reversed sharply downward. Now, you might wonder why the market declined despite a strong candle breaking above the resistance level, sustaining above the day's high. To answer this, you need to zoom out on the chart to a larger time frame. If you open the 15-minute chart, you'll see that the market dropped sharply below this exact level. This indicates that a large number of sellers are positioned here, making this level significant for them, since their stop losses are located just above it. To protect those stop losses, they can still apply selling pressure. Therefore, As soon as the price reached the seller's entry zone, they once again created strong selling pressure with fresh orders, causing the price to decline sharply. This is why the candle here should be considered an inducement candle. To avoid falling into this trap, when making trade entries on a shorter time frame, such as the 5-minute chart, you should also check important levels on at least the 15-minute chart. Mark these levels and plan your entries accordingly. If you already identify the resistance created by sellers' stop losses in this area, instead of going long, you could position yourself for a short trade. That's why, at the start of the trading day, you should mark important levels on larger time frames. Only then can you safeguard yourself against inducement candle traps. Let's now review all these techniques in a shortcut way. Number 1. If the price gradually moves upward or downward, creating stop losses for retail traders on the chart, and later breaks this area with a large bullish or bearish candle, then most of the time such breakouts are designed to trap retail traders, leading the market to reverse and grab the liquidity created by their stop losses. Therefore, in these chart patterns, you should avoid entering in the breakout's direction. Number 2. If the market consolidates within a range and breaks out of that range with a strong momentum candle, most of the time the price will sweep the liquidity generated by stop losses in that area and return to the consolidation zone. This point becomes highly psychological for retail traders, creating maximum interest. Such breakouts are usually false. However, if the market breaks above this zone and sustains trading above it for some time, then you can consider entering in the breakout's direction. Number 3. If the market breaks an important psychological level directly without retracement, most of the time the breakout will not sustain, and the price will reverse. This happens because traders who already entered earlier may book profits at this level, while new retail traders enter fresh trades, adding buying pressure in the opposite direction of the breakout and forcing a reversal. However, if the price consolidates near this level for a while, allowing new traders to participate, and then breaks out, you can take a trade with a small stop loss, minimizing risk. Number 4. If you execute your entries on smaller time frames, you should always mark the key levels from larger time frames. This helps you identify where institutional sellers or buyers are most active, making it easier to predict which direction will be more profitable to trade. Number 5. Most of the time, in a bullish trend, you'll notice false breakouts to the downside, and in a bearish trend, you'll see false breakouts to the upside. Through these moves, the market sweeps retail trader liquidity. Therefore, always plan your trades in the direction of the overall market trend. Number 6. Always remember that breakouts on charts are rarely genuine. They are usually orchestrated to capture retail trader liquidity. For this reason, your focus should be on identifying retail trader liquidity on the chart under any market condition. That's it, traders. The future is being shaped by the actions you take today. Watching this video was a step forward, but the real progress starts when you apply what you've learned. If you gained value here, smash the like button. And if this is your first time, subscribe and hit the bell icon, because you don't want to miss what's coming next. Keep investing in yourself, keep leveling up, and I promise, you'll see the results. I'll catch you in the next video.